Welcome to the podcast. If you're watching on YouTube, welcome there as well. Big one today about, it's actually more of an update. Back in September of last year, I did a real estate podcast and video talking about how much I thought prices were going to drop in real estate. And it was more of what would I be looking at to buy? Like how much of a drop would I anticipate before I say, yes, I'm going to jump in and buy it. Okay, and I did this back in the napkin valuation. One of the things I said on that was, this is static. So it changes over time because mortgage rates change and all that type of stuff. So you have to update it. So that's what we're doing today. Going to update the valuation on how much I think prices should be dropping from the high. They might even be that low in your area already. So with that being said, let's jump into it. Before we do, if you're listening on the podcast, be sure to subscribe so that way you're notified when new episodes come out. If you're watching on YouTube, subscribe there as well, so that way you know when videos come out. Be sure to put a like, some comments in. Most importantly, make sure you share this with your friends if you guys are getting value from this, because like they need help, you need help. It helps them, it helps you. If you like it, you share it, you subscribe it. It helps us grow. Everybody wins. So make sure that you guys are doing that, please. So let's jump into it. This back to the napkin valuation. Those of you that have been following us for a while on the podcast or on YouTube or even just watched the last video of all this stuff, you guys already know this. Those of you that don't, my background actually before I started FitBucks was a valuation analyst. Okay, basically valuing stocks all the way through art collections. Okay, obviously real estate is one of those things that I used to value. When we do valuations, they're very complex. Okay, there's a lot of different moving parts. There's a lot of formulas. There's a lot of algorithms. There's a lot of spreadsheets, all that type of stuff. However, like when I do stock investing, for example, or real estate investing, oftentimes I'll look at a company like a stock, get some numbers, and do what we call a back of the napkin valuation. Or like if a family member is saying, hey, like I'm thinking about buying this rental property. Do you think like what type of value is there? I'll do like a back of the napkin type of valuation. It's just real quick, some quick numbers to get a general idea of where things are at, to come up with a game plan and to start understanding what do I need to know further. And so that's what I did with this back of the napkin valuation. Just like last time, we did it with a debt buyer. So like if you were going to be using a mortgage, also did it with a cash buyer to say, hey, like what happens if you were buying cash, like you buying a house with cash, to see what that was, because a lot of people were buying houses with cash. Okay. So those are what I'm going to go through, just to give you some frame of reference last time. The debt buyers, we always reference this off of the high. Like that's what I'm referencing it from. From the high, the peak price, how much would something have to decrease? Last time I said if it was like a debt buyer, about 30%. If it was a cash buyer, about 50%. And I don't think that cash buyers are going to be coming into the market as much as they were. They still might be, but not as much as they were. Therefore, I put a lot on the debt buyer situation, which meant about a 30% drop, and that's what I was looking at, all else equal. Okay, so I'm going to redo those numbers today, and then I'm going to give you two things to look at: either a housing price drop or what do mortgage rates have to drop to in order for you to be like, oh yeah, these are properly priced. Okay, because those are two variables that can change. Now, in my area, housing prices are already down about 17%. Okay, just to give you some frame of reference. Actually right now in the comment sections, if you guys can take a minute and just say, estimate what you think the housing rates or housing prices are down in your area. Are they down 10%? Are they down 5%? Are they down 20%? That's one of the things that if you don't know that, I'd actually probably pause this podcast or video. Maybe go find that out right now. Just go to Zillow, look at, say, highs in the area in 2020, or Google it and get that high, then go look at what they're listed for right now and say that. So again, if you know what that number is off the top of your head, put that in the comments. So that way people watching this can get a feel just in general what things have gone down to. Okay. Debt buyer. I'm going to walk you guys through this. If you're on the podcast, I know you can't see this, so I'm going to walk through these numbers with you. Okay, so the valuation on the houses around where I live, they peaked at about $850,000. Okay, now I'm going to use a hypothetical down payment on this, where people were putting down a 3.5% down payment. Now, some of you that know real estate, you're like, well, you can't use a 3.5% down payment. I know that. It doesn't matter at the end of the day on the numbers. Again, this is a back of the napkin valuation. I I get it. Like, it's fine. I just am trying to get to some implied numbers because none of these numbers, only a couple of these numbers change, right? So that number doesn't matter. But that would imply a debt amount of $820,000, okay, that people were borrowing. Now, at that time, the rate was about 3.25%, okay, on loans. So on a mortgage that size, the monthly payment was about $3,570, okay. The tax was in my area, and this is why you have to do this in your area as well. My tax here in Texas is 2.25%. And so between my tax, the property tax, and the interest rate, and the monthly payment, I should say, I was paying about $5,000, or somebody would be paying about $5,164 a month, okay? That would imply a DTI ratio of 50%, which is on the high side. Most of them only go up to 35 or 40%. But again, that doesn't really matter, okay? What we are primarily looking at is just some of these implied numbers. And the implied number that I'm trying to get to is implied income. What was the income of people in this area if that was the number? For that, it's just shy of $124,000. It's actually about $123,925. Okay, so I'm going to round up. It's $124,000. That was when interest rates were at 3.25%, but that was the base number that I'm trying to get to, is that implied income. What's the income in this area based on these housing prices, okay? So now, though, interest rates are now, we just got this notification from one of our mortgage lending partners, Neo Home Loans, Movement Mortgage said the same thing. They're starting to see rates right around 6%, okay? So that means, based on our numbers, that would imply, based on our cash flow, remember, it's all about cash flow. That's what banks underwrite you on, is cash flow. Again, I just want to back up there too. It's not what you can afford, it's what they underwrite you for. And even though all of you know, like, hey, before I buy a house, I should go into FitBucks and see actually how much home I can afford, a lot of your neighbors don't know that. So they're just going to the bank, whatever they qualify for, they're going to go buy a house with that qualification. And so that's going to put a floor value on houses, okay? So with that being said, that would imply a loan size of about $595,000. And so then I can back solve into what's the housing cost. It's about $16,000. And so I did some rounding, and that would imply that houses in my area would be a good buy based on the current interest rate environment if housing dropped 25% from the high, which would mean about $630,000, okay? Like I said earlier, houses in my area are about 700 to 725. They've dropped about 17 to 18%. I'm saying I want it to drop about 25%. But now this is why this is important, okay? Is this gives me two things. And I've already told my wife this because as you guys heard in the last podcast, the reason why I was doing this was because it's like, I want to know when I think to potentially go out and buy a rental property. When I think like a single family house or an apartment or something like that is a good buy. Okay. There's two things I can do now. I can say, well, if housing drops down into that range of 620 to 640, I'm going to buy. That's my target purchase price. But because houses are at 700 grand right now, and a lot of sellers are out there, and a lot of people can't afford houses, I might turn around and be like, okay, I'm going to start putting offers in on houses. If my neighbor is selling, a house for 680 or 690 or 700, I'm going to go put in 620, 630. What do I got to lose? I hope they offer it. And a good real estate agent right now is not going to fight you on that. And the reason being, again, I just talked to the guys at Neo Home Loans and Movement Mortgage, and this is what we're seeing a lot. If you put in an offer and somebody's asking for 700 grand for a purchase price, and you agree to that offer, appraisals are coming in low again. And you can only get the home and the loan based on the appraised price. So if the appraisal comes in at 640 or 650, you're not getting the loan. You're going to have to come up with a lot of money to close that gap. So a lot of places, even though the seller might be saying, oh, well, 700 grand, they're not going to get that one way or the other. So if you have a good real estate agent that understands that, they might turn around and be like, yeah, put an offer at 630, because it might be the only one that they get, first of all. Second of all, it might be the only one that actually qualifies for the mortgage. Okay. And so if you're looking for houses, you might, in your area, and you're doing the same thing, and that's in that close of a range now, because that's not that far off, right? 17% or 25%, it's not that far, that much of a difference. Start putting in prices. Why did I come up with this theory? I used to do the same thing with stock investments. I would value a stock, and let's just say I thought it was worth $20 a share, but it was currently trading at $25 a share. I go in and sell put options off of it at 20 because that's what I wanted to buy it for. It's the same type of thing with this. You don't lose anything by putting in the offer. Like if it's at 700 grand and you put an offer at 630, the worst they're going to say to you is no. Might as well do it, right? You never know. You never know. Now, the second thing, though, that this allows you to keep an eye out for. So the first thing, just to reiterate, is I want to buy a house for this price. In my example, it's a 25% decrease from the top, which is about $620,000 to $640,000 in my area. Okay. Now, the other thing I can look at is interest rates on mortgages. So I could back solve into this too and say, look, if mortgages drop down to about 5 to 5.25%, like we're right at the current purchase price of 700 grand at an interest rate of 5 to 5.25%, I would say, yeah, now it's properly valued. And I would go in and buy the house at 700 grand if interest rate drops. So that gives you two pieces of framework there. Either the purchase price is going to drop and interest rates stay the same, and I want to be about 620 grand to 640. That would be my purchase price. Or the purchase prices are going to stay the same around 700, but the interest rates drop down to quarter. Then I would say that's the floor in the market or around the floor. And that would be a good time to buy. Again, I look at this, from my area. I could say yes, nationally, these are going to be pretty similar in all the different areas. But again, that property tax piece, that's one of the big things that changes. So again, that's right there. And I'll give you an example. Like if I come in, those of you that are watching the video, you guys can see this. If I drop that tax rate down to 1.25%, it changes a lot of these values in here in terms of what I can actually afford. And actually my Excel model is broken because I actually hard coded a lot of this for this, but it would change it. It would change it to say, hey, I got more money available for my mortgage now. So that's how you would do this type of stuff. That's why the tax rate is so important to tie into this stuff. Okay. So that is the podcast for today. Oh, by the way, I just noticed I didn't go through the cash side of this. The reason being is because it would be a price drop of about 40 to 45%. But like I said earlier, I don't think there's a lot of cash buyers out there right now. There are still some, but nowhere near what it was before. So I don't think they're going to be the ones providing the floor price on this right now, unless interest rates drop again, right? Which we'll see. I don't think that's going to happen anytime soon in the next few months. I think the floor will come in from buyers that are using debt. And I think that the floor might be coming up here soon. Because inventory data inventory is really low right now. So that puts a good stability on the bottom of the market. That's start putting some offers in. If you're doing that, like I said, like I did mine in this valuation in this area, 620 to 640. See what gets taken. See if it's taken. Go from there. So that's the podcast. That's the video. Like I said, if you guys like the content, make sure you subscribe so you get more notifications when everything comes out. If you're not already a FitBucks member, sign up. Our technology is awesome. Help you build your financial plan, answer your questions like how much home you can afford, should you be paying points on a mortgage or not, all that type of stuff. We have all that technology on our platform. We'll talk to you guys soon.